Everything going good?
Oh, you know what? To be honest with you, I wouldn't say things are going good. Things are probably going about as expected.
Yeah,
They could be worse, and I guess they could be better. And we're living in surreal times.
we really are. I mean,
And to be honest, Rory, most people don't realize how surreal everything really is.
no, they don't. They walk around with blinders on and
Yep.
don't want to see, don't want to be told the truth, don't want to know about the truth, aren't concerned with it. Please lie to me.
Yeah, and there's a number of people that are highly educated that are in that certainly should know better, and I believe do know better, and they'd rather whistle past the graveyard, and they've got so much invested in the current failed system that they don't want to be the ones who pop the bubble.
I would tend to agree with that 100%. I mean, they have to know, unless they're just willfully. Well, it's just willful ignorance, is what it is. I mean,
I don't even think it's willful ignorance. I think it's a question in a lot of cases for a lot of members of the establishment and members of the Fourth Estate. I think it's willful aiding and abetting a criminal activity, and I think it's sort of wrapped into they've basically been shown examples, highly publicized examples of what happens when people turn either whistleblower or truth teller. Whether it's Gary Webb, whether it's Edward Snowden, any high profile person with knowledge of how the system works, if they grow a conscience, they know that they're dealt with in very extreme ways.
Or their life is going to take a very dramatic turn.
Yeah, they're snuffed out.
Yeah, it could be. Well, it could be something like, I personally believe that Dominique Strauss-Kahn was set up because he wasn't going to play the game any longer. So,
well, yeah, his partner's dead.
Oh, well, there you go.
And I remember reading about that. I think I have the headline right here. Just a second.
Yeah, that wasn't too long ago.
Oh, it was a couple weeks ago.
Yeah, he was one of the latest suicides.
Yeah, but what were the details of that one? Let's see.
Was that the one that killed himself and killed his family? Or there's been so many of them.
Well, oh God, yeah. When you talk about banker suicides, which one?
Oh, and then this guy, a couple of days ago, found in his tub with his throat slashed over at. He was a member of Citi, which is another one of the criminal organizations pretending to be a bank.
Yeah, here it is. Like this one's dated November 5th. This one's dated November 5th. Last week, Strauss-Kahn's business partner, Thierry Lane, fell from a building to his death in Israel, an apparent suicide.
Yeah, it's how many more of these guys are going to jump from a building
I don't know.
in an apparent suicide before it's? I mean, it's got to be as Sean has pointed out many times. You couldn't get an insurance. The statistics on that are so off the chart. I mean, you're Rob Kirby of Kirby Analytics, and your job is to work with numbers all day long. That's what you do. You look at statistics all day long.
I'm not even really necessarily math oriented per se. This whole thing really got to me because I came from an institutional background. I worked with the instruments that have grown to colossal size on the off-balance sheet segment and the derivative segment of principally 5 American banks, where you get a little bit of visibility on some of the numbers. And when I see the size of their books, and especially through critical periods, like you see the overwhelming majority of the derivatives complex is interest rate derivatives. interest rate derivatives are credit instruments. And what really drew my attention to all this malfeasance was watching the growth in key players like a JP Morgan in the third quarter of 2007 when we had a freeze in the credit markets. And like you got to understand, back in that time, I was still talking to guys like that worked in brokerage, institutional brokerage, and guys that worked in treasuries at banks. And I know that the interbank markets froze shut. Like people were sitting in their chairs in trading rooms at banks, staring at each other for a period of, a couple of months during that credit freeze. I know what that's like. I went through the S&L crisis back in the late 80s and early 90s. And there was a credit crisis then. And I was working on a swap desk and an off-balance sheet derivative desk. And we sat there for a period of weeks, if not into a month and a half, where we didn't do a trade.
Oh, my.
There's no interbank trading. And I can tell you in 2007, banks wouldn't even lend to each other on an overnight basis. The interbank lending market seized up.
Right.
And so what I'm saying is no banks were trading with anyone except JP Morgan. They did $8 trillion in 3 months. See, that is such an outlier. That is such an outlier. It drew my attention. And you see, it was during that time period that I know that the duration of those trades that were put on were such that they all rolled off in 3 months. Because their book went from 24 trillion up to 32 trillion. This is the less than 1 year component of their swap book. Okay? It went from in Q2, it went at the end of Q2, it was 24 trillion. Q3, it went up to 32, and then it rebounded back down to 24. So that's in the depths of a credit crisis where no banks were doing any credit instruments with anyone.
Goodness gracious.
See, and that identifies the product that they were trading, and it's called an FRA. You see, because banks have to report. Banks do report their off-balance sheet activity. They're mandated to report their off-balance sheet activity by a regulatory filing on a daily basis called a call report. And OTC swaps, there's only two. There's two product lines that make up OTC swaps. That's an interest rate swap and an FRA. Those two products are OTC swaps.
Okay.
That's what OTC swaps are. One of those two things. The FRA is the only product that you can put on in one quarter and then have it disappear the next.
Okay.
So that identified when their book swelled by 8 trillion in Q3 and then went back down to what it previously was in Q4, that identified the product as an FRA. And then when you overlay what occurred in the short-term interest rate market in Q3, you saw that 3-month T-bills cascaded down over 200 basis points literally in about 2 days. And that identifies what happened.
Okay.
Because you know it was an FRA trade that happened. You know that no bank was involved on the other side of Morgan's trades because banks were excluded from the market because there was no credit banks weren't extending credit to any other player.
Right.
So it means the other side of the trade was the Treasury.
Okay.
Because they're the only ones that have the heft to do that kind of business. 8 trillion. Literally in days. Because you see, if you understand credit, and if you've ever worked on a trading desk, you know that banks don't have infinite credit lines for other banks, especially in a credit crisis. So to think that other banks did JP Morgan for 8 trillion in these credit products when banks wouldn't even lend to each other overnight is a non-starter. So you know it's the Treasury. And you know what the Treasury was doing by what happened in the T-bill market. And that, by the way, is when LIBOR was first reported to have been broken. And the reason it was reported to have been broken, the T-bill rates were forced down. So you see, you buy an FRA, it's a synthetic borrow. You sell an FRA, it's synthetic lending. If I synthetically borrow, I need to buy something that has yield to lock in a profit. If I'm borrowing from the Treasury synthetically, I buy their T-bills to lock in a profit. So if you sell me a 3-month FRA at a yield of, say, 380, and I'll do that as long as I can buy your T-bill that yields 390. I can lock in 10 basis points risk-free.
Okay.
Do you understand that?
I do.
So that and that's what was occurring. You see, normally in the interbank market, FRAs trade against a Eurodollar strip, a strip of Eurodollar futures. The normal hedge for an FRA is to buy Eurodollar futures. But when the credit markets froze, the U.S. Treasury panicked, and they knew they had to get rates down. You see, and banks being credit worried and being loan averse were raising LIBOR rates because that was reflecting their want to lend. And the reason they didn't want to lend is because, you see, what precipitated this whole crisis in 2007. This is really important stuff, Rory, because this is where the whole financial crisis came from. This is the egg cracking open on the financial crisis.
So this is what's actually broken and what is causing all the problems that we're dealing with today.
Well, the financial crisis began when Bear Stearns failed.
Right.
And when Bear Stearns failed, the reason they failed is because they had 2 hedge funds inside that company that were loaded up with subprime bonds.
Right.
Subprime real estate bonds that were all rated AAA. And those subprime bonds failed, but they were rated AAA. It was the first time in the history of credit markets that a AAA credit failed.
Wow.
Do you understand the gravity of that? Up until that point in time, AAA credit had never failed.
Well, it's
AAA credit can get downgraded, but AAA credit had never ever failed. So, and that's what led to the credit freeze. Because if AAA paper could fail, I don't want to buy no paper no more.
Right.
Because I don't know what AAA is.
It's meaningless.
Right? And I don't want to lend no bank no money because I'm afraid they might own a lot of that AAA paper that's going to fail. I could lend them money today and they could declare overnight that they're bankrupt. That's why the credit markets froze. The Treasury panicked. And if you understand, the first time that the LIBOR was ever spoken about publicly about being broken is when the T-bill rates collapsed down, but the Eurodollar future rate stayed high. Understand the Eurodollar future rate is a LIBOR product.
Okay.
The T-bill is a government debt product. The difference between the two in yield is referred to as the TED spread. T for Treasury against ED, the Eurodollar future.
Okay.
The Eurodollar future or LIBOR rate is supposed to be a reflection of where banks are willing to lend to their most creditworthy customers. Hence the term LIBOR, London Interbank Offered Rate. The London Interbank Offered Rate is determined by the Eurodollar future. When the credit crisis happened and when the T-bill yields started to collapse down, the Eurodollar futures actually started to bop. First inclination was to go higher because that was reflecting banks' unwillingness to want to lend money. And that caused a ballooning of the TED spread because you had the T-bill rate and the Eurodollar future rate normally trade in a very narrow band, very close to one another, reflecting that, you know, there's an historic norm as to where corporates borrow over the government. And people in treasuries around the world and all companies are always acutely aware of how much of a premium they have to pay over sovereign debt for money in all tenors. And Like my biggest account in these products was the biggest account in the world. That's where all this started. Was in 2007, and since then, it's been just a litany of continued crime, misreporting, and or there's a certain constituency in the mainstream that have no idea how any of these instruments work. But there's also a constituency that does know how it works, and they won't say anything for fear of being, if they're still in the profession, they don't want to lose their job. These are people that are basically living the life of Riley. I mean, listen, that's where it all comes from, and I don't know. I don't know if what I've said makes any sense to you or not.
It does. I mean, and
I've written all I can tell you, Rory. You see, I've written and documented all in a litany of articles. I've got about 900 articles in the public domain. I've probably written 24 on this. The media won't report it.
No.
The bankers, I'll just tell you something. All I can tell you is they all need to be called out for being criminals.
Yes.
Because you see, for them to say that they were wrapping their themselves in the flag, and it was for national security, which is what they're doing.
Right.
It's sort of like Hitler's officers saying that we were following orders.
Right. It just don't work that way.
But all I can tell you, what's been done transcends that. And what's been done in the name of protecting dollar hegemony and protecting America in its spot as the leader of the free world and the vanguard of the global financial system, it is sicker. It is sicker on many levels than what the German leadership did in World War II.
Yes, I would agree with that. I mean, it's a crime, and people.
Yeah, crimes against humanity. We're talking massive crimes against humanity, and here's the issue. All of this crap is what is at the root of all the geopolitical tension in the world right now.